And investors who had been banking on multiple rate cuts this year now have the surprising jobs report reducing those odds. So why did the Fed start cutting rates in the first place if the data didn't support it? Or if it's changed, then what should we do now? Let's discuss with Dryden Pence, the CIO of Pence Capital Management, and Steve Leisman, our senior economic reporter, both of whom are with us today. You look like you're shaking hands before a match. Exactly.
And we will not talk about foot fungus on this show, Steve.
That's an
the
inside
reference to
joke.
Squawk Box.
I don't even want to know. So, Dryden,
no, you don't.
Maybe you can back into the lane of what the Fed should have cut back in September, or at the very least, what they should do right now.
Well, I think what we're going to find is that people that are banking on rate cuts are going to be sorely disappointed. And I think that it's basically going to be pushed out. If we get one this year, it gets pushed to the back of the year. But our view on it is this. We had a pause at 550 for a full year. The world did not come to an end. We'll probably have a pause at 450 for it could be up to a year, and the world's probably not going to come to an end. So we think this market, there's an overreaction right now, and I think that we basically spent, since 71, you've spent half your life with the Fed funds rate over 4%. And the economy's done fine, the markets have done fine. 23, 24, we're good, and we're paused at 550. So pausing at 450.
I feel like you're channeling your inner Steve Leisman, because if I heard, hi Steve. If I heard Steve properly in the previous hour, your take is that this is a good number related to a good economy, and a number maybe we should be happy about.
Well, look, where you sit determines a lot about where you stand, right? If you're deeply invested in stocks going up at a very high multiple, and that call is based upon future rate cuts, I think you're in a bad place. If you like to cover the economy and you like to see people employed, you like to see wages, and you believe that ultimately earnings will be determined by the strength of the economy, was determined by the number of people employed and how much they're spending, then yeah, long term, I'm chill on all that.
This is the good news.
It's good news.
So we're back. I want to be clear on
I've never been away from that.
No, you haven't.
But let me ask you a question, Brian. Turn the tables. Or maybe our esteemed guest here. What's worth more to you? 250,000 more people employed, a 4.1% unemployment rate, or 50 basis points of Fed rate cuts?
I like people employed.
I'll take the jobs. I'll take the spending. And here's the preview. You're not going to get it any other show, which is just wait till our Monday retail monitor outlook with the NRF.
Strong spending.
I can't say. I'm saying just you wait.
We've added
Henry Higgins, just you wait.
You got it. Thank you for picking up the reference.
My Fair Lady, Robert.
Exactly.
You're very welcome.
We had 0.2 million people last year. That's like the entire labor force of Alabama or Oregon. We've added 6 million people since the pandemic. That's the entire labor force of Illinois. We've 159 million people.
Okay, so why did the Fed cut rates in
GDP.
September?
I think that's a decent question.
The August jobs report was bad. Remember?
There was a palpable sense. Guys, do you have my 3-month average
The carry trade
employment
blew
chart?
up, remember, in early August?
The private sector employment had come down quite strongly, from 170,000 to back then 110,000. One thing I noticed when that number came out was how the jobs were in the private sector this time around. Government spending had picked up the mantle. Government hiring had picked up the mantle for hiring in the economy, and there was a case for worry. There was also a sense, Brian. We set those rates at 5.5 to deal with an inflation problem that was north of 7. Inflation came down. You didn't need quite as much. The real question I think you might ask is, did the Fed overdo it by a quarter? Does it have to put that quarter back? And now I think we're right here in the sense that there's that 3-month average chart. You can see there how much it had tanked at that time, which is exactly what Kelly Evans was talking about, those 2 dips in the middle.
Yeah, it made more sense then. And coincidentally, or for whatever reason, the data started to turn around right after that cut. But this is where Fed speak could have maybe said, kept up that. Okay, yes, we see the stock market taking off. We see the bond yields are rising. We see that the data is getting better. But I feel like we keep doing the same thing from them since September, which is, we think, maybe a few more rate cuts. Okay, well,
I think the 50, which I opposed at the time, made a mistake. Quarter, then you haven't, you've got.
Because you said, would you rather have the jobs or the rates? And I think if your rates are locked in, you'd rather have the jobs. But I think for a lot of people that were hoping that mortgage rates would come, they don't care what the Fed funds rate is. They care about what they're borrowing. They want to buy a home, so they care about the mortgage rate, I think. Where no one sits around the table and goes, gosh darn federal. I mean, maybe we do. No, but we're the ones, the Federal Reserve, the Fed funds rate.
Even realtors at the time would talk to us and say, well, the Fed just cut rates, the mortgage rates are coming down.
That's right.
Exact opposite.
Because it makes sense. The Fed cut, so I'm thinking rates are coming down, and Dryden, the Fed cut, and all that's happened is the market has rebelled, and I'm just, in my little pea brain, just trying to figure out why.
Well, I think the market is overreacting to this idea about cuts.
Now,
right? Yeah, absolutely.
At 475 or wherever we are.
Right, wherever we are. I mean, I think the point of the matter is we're overreacting to the fact that they didn't get the cut, and so now they can wait. They have dry powder. They didn't have dry powder 5 years ago, right? We're in quantitative easing. So the Fed has the luxury of being able to wait so that they can kind of pause this out for a while, and it's all right.
But we have to kind of put this, does this change your view on the multiple you'll put on stocks if you don't get those rate cuts?
I think it makes us feel like there's not that much multiple expansion left. What I'm going to pay attention to is earnings. I'm more interested in the bottom line than I am the headline. And so when we look at earnings growing by 10 or 11% next year, you say the multiple kind of stays the same, then you got a positive market. I mean, it's not another 20% in a row, right? But it's still a positive market moving forward. And it's all about earnings.
Brian, I said in the last hour, I thought that the market thought it was going to get its cake and eat it too. You were going to get a positive, stronger economy with maybe a boost from the incoming Trump administration, some of those policies, and you were going to get Fed rate cuts. Well, guess what? One of the three things coming off the table, it would appear.
When do we start talking about rate hikes?
People are already starting. Bank of America in its notes most likely next step. Now, when it went
the CME Fed Watch tool, Steve. See, I'm channeling my inner Steve Leisman. If I go to December, it only shows a 25% chance that rates are where they are now, and that we're likely to get a cut.
Yeah, that's right. I don't see any pricing at all in this. I'm looking at right now the entire forward structure of the Fed funds futures curve. I don't see any pricing at all for a hike. I think we're a ways from that. I think, Kelly, the way the Fed would take that is let it run several more months of hot job numbers, accompanied by high wage numbers in which the job market showed itself to be a threat to the inflation, which it's not believed to be now, and then persistently higher inflation, especially in the service sector, that could turn the Fed around, but it would take several months to that day, I think.
Yeah, indeed.
Dryden.
Thanks.
Thank you.
You're welcome. Thank you very much.
Dryden Pence, Pence Capital Management.
You're welcome.